Hi, everyone. Welcome to today's MNI Webcast. I'm Pedro da Costa, and it's my pleasure to be hosting Richmond Fed President Tom Barkin today. Tom has been a member of the FOMC since 2018, and he brings a unique real economy perspective to his role, having previously worked as senior partner and CFO of McKinsey, as well as having served on the board of directors of the Atlanta Fed from 2009 to 2014. The last time President Barkin joined us for one of these, thankfully we've gotten to talk in between then and now, but the last webcast we had with you was in the depth of the COVID pandemic in 2021, when the economy was still firmly in the grip of COVID. Thankfully, we're largely past that particular crisis, but of course that doesn't mean there aren't still plenty of challenges facing policymakers at the FOMC, not least of which the decision as to whether they've raised interest rates enough to tame inflation. So thank you so much for joining us today, Tom, to address this and other looming policy questions of the day. Just to give everybody the lay of the land, we've invited President Barkin to kick us off with about 15 minutes of opening remarks, and then we will jump right into a Q&A for about an hour after that. So running until about 12:15 Eastern time. Now, I've got lots of questions of my own, but also very much welcome and encourage the help of viewers and listeners. So please send in your questions using the chat function on Zoom. To be clear, the webcast is fully on the record. So thank you all again for joining, and thank you, President Barkin. I'll hand things over to you to get started.
Thanks, Pedro, and it's great to be back with everyone. I do kind of have that COVID feeling again here on a webinar with a bunch of people who you don't see, but I'll try to spice up. Hopefully we'll have some fun today. As you said, I'll probably spend 10 minutes on what I think is happening in the economy and open to all your questions. You know our standard disclaimer that these are my thoughts alone and not necessarily those of anyone else in the Federal Reserve System. Okay, so let me start with some stuff which is that the Fed has moved aggressively against inflation by raising rates 525 basis points in about a year and a half. Regardless of what you think about interest rates, hopefully you agree we need to take action. I will say it's just, if there's one thing we've relearned painfully over the last 2 years, it's just how much everybody hates inflation. They hate it because it creates uncertainty. As prices rise unevenly, it's unclear, where do you spend, when do you save, where do you invest? They hate inflation because it's exhausting. It takes effort to shop around for better prices or to handle a complaint from an unhappy customer. And they hate high inflation because it feels unfair. The wage increase you just earned feels arbitrarily taken away at the gas pump. And so we're moving aggressively against inflation, and I hope you agree we're making real progress. In September, 12-month headline PCE inflation was 3.4%, down considerably from its peak of 7.1 in June of 2022. Core was 3.7. In the last 3 months, core has been 2.5% annualized. So we're not at the 2% target yet, but clearly we're headed in the right direction. At the same time, the data shows an economy that's remained remarkably healthy. Despite many fears of a recession, we continue to see strong demand and a resilient labor market. GDP grew at a remarkable 4.9% in the third quarter. Consumer spending was robust, up 4% annualized. Unemployment remains low at 3.9%. Job growth has averaged 204,000 over the last 3 months, which is roughly double the break-even rate. Now, if you had asked me for my forecast a year ago, I would have been pretty happy to be at 3.4% inflation and 3.9% unemployment at this point. We've come a long way quickly, but the job isn't done. Inflation remains too high, and the Fed has to walk a fine line. If we undercorrect, high inflation could return, as happened in the 70s. If we overcorrect, we do unnecessary damage to the economy. And even the best policy has the potential to be waylaid by external events, as we've been reminded by the recent news from the Middle East. I'd say our job's complicated by what I think is an unusually wide range of potential paths for the economy going forward. You could make a case for a resurgence. You can make a case for a soft landing. You can make a case for a recession. So I thought I might just talk about all three of those potential cases and what they might mean for policy. So one path is reacceleration. Demand picks up, and in turn, eventually so does inflation. And you could read the recent data to largely tell this story. Third quarter GDP growth defied expectations, fueled by consumers spending down pandemic-era savings and benefiting from higher wages and stock prices. The high-end experience economy is a particular hotspot. Despite a slowing in housing activity, home prices have renewed their upward climb, a testament to continued demand amid tight supply. Construction remains strong, supported by infrastructure spending and an AI-fueled data center boom. And the job market has been remarkably resilient. Vacancies have ticked back up, jobless claims have moved down, and wage growth remains elevated. Demand this strong just isn't the fix for inflation and would likely require even more from us. But I don't like depending solely on the data. It's published with a lag, it's revised multiple times. And so, as you said in your intro, I'm just on the ground every week in the hope of trying to understand the economy better. And I hear a different story on the ground. What I hear on the ground is that interest-sensitive sectors like real estate, manufacturing, and deal making are feeling the impact of higher rates. I hear pandemic-era stimulus and excess savings have largely been spent down. Retailers tell me that lower-income consumers are stretched and reprioritizing their spend, and middle-income consumers are trading down, perhaps still buying beef at the grocery store, but school notebooks at the dollar store. Banks are feeling margin pressure, and they've stepped back from riskier sectors, newer customers, and less profitable loans. An alternative way to look at consumer spending, instead of the 4% that we saw in the numbers, is year over year. And if you look at consumer spending year over year, it's about 2.4%. Those growth numbers look solid, but not frothy. And that's what I hear in the marketplace. I hear solid, but not frothy demand. And it makes me think that the data we're looking at may just be showing a catch up from a weak spring. So the second potential path is the elusive softish landing in which demand remains solid while inflation comes down to target. The argument for that is that rate increases and tightened credit conditions both work with a lag and may work to bring inflation down further in the coming months. Labor markets clearly coming into better balance. Inflation expectations seem to remain anchored. And the supply side has been working to bring inflation pressures down. Supply chains are largely repaired. Gas prices have backed off last year's highs. Productivity is up. Prime age labor participation has rebounded. And if all these forces continue to work to relieve supply pressure, maybe inflation could return to target without more help from us and without too much damage to demand. But I'll speak for myself and say I'm just not yet convinced that inflation's on this smooth glide path down to 2%. The inflation numbers have come down, but much of the drop has been the partial reversal of COVID-era goods price increases, like in used cars, driven by elevated demand and supply shortages. Shelter and services inflation still remain higher than historical levels. And as I talk to businesses, I'm still hearing too many stories of above normal cost and price increases. Healthcare costs are spiking. Anyone who's renewed their property insurance in the last month has seen that homeowners insurance is spiking. Merit pools, I hear, are down, but still above pre-pandemic levels. The recent UAW settlement could spark another round of labor cost pressure. Large consumer goods companies in sectors like detergents, frozen food, and soft drink are still raising prices at rates much higher than before COVID. And I just think more broadly, after decades without pricing power, businesses aren't going to back down from raising prices until, and this will happen eventually, until their customers or competitors force their hands. Now, don't get me wrong, I'm not rooting against a soft-ish landing, but I fear more is going to have to happen on the demand side to convince price setters the inflation era is over. So the third path is the traumatic recession that so many have been forecasting for so long. It could be driven by the Fed's aggressive rate path, by banks pulling back in force, by geopolitical events, or by some new financial crisis stemming from troubled sectors like commercial real estate. That kind of downturn usually works to bring inflation down and turn policy on its head, unless, of course, it emanates from a supply shock in commodities like oil. Now, we're clearly not in a recession today, based on the strong data I shared. We will clearly be in a recession someday because nobody ever canceled the business cycle. And I just keep remembering that most recent recessions don't come from this gradual glide into a recession, but from unforeseen events like the pandemic or 9/11. So I've described and rejected three paths. So what path do I see? So here's where I see it going. I do anticipate some sort of slowdown. I just have to believe the net impact of all this tightening is eventually going to hit the economy harder than it has to date. As an example, I saw some interesting data last week. Corporate interest payments as a percent of revenue and household interest payments as a percent of disposable personal income have now both only gotten back to 2019 levels. The benefits that each of those got from pandemic era refinancing and debt repayment won't last obviously long at current interest rates. So I do anticipate some sort of a slowdown. I see that slowing as part of what it's going to take to bring inflation back to target. As I said, I do think price setters are going to have to be convinced. Now, whether a slowdown that settles inflation requires more from us remains to be seen, which is why I was supportive of our decision at the last meeting to hold rates. With rates restrictive and financial conditions tightened, we have time to reconcile competing narratives on demand and to test different views on the trajectory of inflation. I will say that if we do see the economy weaken, it's worth remembering that not all slowdowns are created equal. We've been scarred by memories of the Great Recession, and for those of us who are older, of the Volcker Recession, but those were particularly long and deep. And as I talk to firms, I hear at least 3 reasons to believe that any downturn this time might be less severe. The first is I see less dislocation in the labor market. When you think of a slowdown, you naturally think of 2008, when manufacturing workers were sidelined across the Rust Belt. Those last into the workforce bore a disproportionate burden. But those are the workers I hear that are most in demand today. Manufacturing plants, hotels, construction sites, restaurants still remain short of workers. If you look at the large company layoff announcements this year, you'll see they primarily have targeted administrative functions, not frontline workers. And those professionals may have a lower propensity to file for unemployment in the first place, be unemployed for shorter periods given their educational background, and often can leverage backup savings to bridge their consumption. Unemployment for those with a college degree is just 2.1%. Second, a spending slowdown could be mitigated by latent demand. I mean, there are a lot of people over the last 3 years who've wanted to buy houses and wanted to buy cars, but found that they became expensive and hard to find. But should supply open up in a weakening economy, I suspect we're going to find a number of these buyers who have deferred purchases over the last few years will be ready to buy. And finally, the extended preamble to this recession could reduce the cost. This has been called the most predicted recession ever. The businesses I talk to have been planning for a recession now for 18 months. In their 2023 plans, in their 2024 plans, they've slowed hiring, they've streamlined costs, they've managed inventory levels, they've deferred investments. Banks have cut back already on marginal loans. Many consumers have tightened their belts. So if a recession does come, the economy ought to find itself less vulnerable, less over its skis than it does in one of these other recessions that we remember that sort of came out of left field suddenly. You might even argue that the recent strength in the economy is being supported in part by businesses, consumers, and governments that have outperformed the recessionary forecasts. So that's how I'm seeing the economy. I'm sure you guys will have lots of insights and thoughts, and I look forward to it.
Thank you so much for that, Tom. Really, really nice way to get us started. If I could follow up a little bit on this gap that you've identified today and in prior remarks about between the top line data and what you've been hearing from your business contacts. It's also a gap that you see between, the hard data and the consumer surveys as well, right? Consumer sentiment and even the president's ratings on the economy are especially low given the strength of the labor market and the strength of top line growth. To what do you attribute that gap? Is it an issue of kind of the data lagging, or is it an issue of maybe what's happening at the top, the strength that's taking place at the top masking a lot of weakness in the middle and bottom portions of the income? Why are people feeling so glum if things are great?
Well, so I do a lot of interaction with chambers of commerce and other groups in the economy. And I often ask this question, unemployment is in the 3s. Why is everybody so unhappy? And the one thing that I think is undeniable is that inflation is a downer. I mean, people don't like inflation. And when you look at these consumer sentiment surveys, and obviously you look at the 2 big ones, one of them's more about the job market. It's much more optimistic than the one that's more heavily weighted toward consumer spending and the economy, the Michigan survey. And I just think people hate inflation. And it's not just inflation the way we measure it, which is a year-over-year increase in prices. It's the overall price level that I think is also affecting people. When we did a Fed Listen session in Richmond a few weeks ago, and I asked this question, and the thing I really took away is that there was people going to the grocery store with very clear memories of how much a 12-pack of Diet Coke cost 3 years ago and comparing it to how much a 12-pack of Diet Coke costs today. And that change in the overall price level, I think, is still weighing on sentiment as well. In terms of the spending, and I mean, I think it's very clear that wealthy people are still spending. I think it's very clear that you're seeing trade down in the middle income and some amount of reprioritizing in the lower income, though supported still by low unemployment, rising wages. So it hasn't fallen off the table in any of those sectors. But like I said, I just don't believe this is a 4% consumer growth economy. I do think that's why I think it's so interesting to look at the 12-month versus the 3-month. And I think then you start asking yourself questions, because all these data are quarter over quarter or month over month, whether we're not just seeing a bit of a head fake from a relatively weak second quarter consumer spending.
Now, it seems to me just logical that the bar for additional rate hikes is increasing as you get closer to the peak, because you're questioning more how far you need to go, and as you say, you have to weigh the risks of under tightening with over tightening. How high is that bar for you personally, and how much, like what aspects of what you've described would you need to see? Would a reacceleration of growth that is accompanied by continued disinflation, would that still worry you enough to tighten? Would you need to see both a real acceleration of inflation and persistent strong growth? What combination of factors would prompt you to support another hike either in December or early next year?
Yeah, the core issue for me is inflation. And so, to me, continued disinflation is what, I'm looking for, not necessarily each and every month, but on a, over time basis. And, continued disinflation to me, suggests that restrictive policy is working in the way you want it to. If you start seeing, though, a return to elevated inflation, then that makes me start thinking that, we need to look hard at whether we need to do more, particularly if demand's strong.
Yeah. So we have a bunch of nice questions coming in already from the chat, so please keep them coming. One is from my friend and colleague at the AP, Chris Rugeber, which is a good line of questions for us to jump into, which is the recent spike in long-term yields, right? We had long-term yields go all the way up to 5% in just a matter of months, from 4% in August. That was a significant tightening of financial conditions that some Fed officials nodded to as possibly doing your job for you and therefore lessening the need for additional tightening. I know you pushed back a little bit against that notion, but now to complicate things further, yields have eased significantly from those peaks. So where does that leave financial and credit conditions at the moment? Are they still tight or less tight?
I'm probably going to avoid the temptation to comment every day on financial conditions as they move. But, what I said a couple of weeks ago about this is that I pay attention to the level of rates across the curve as an element of financial conditions when I'm looking at how much restrictiveness is brought into the economy. I think, monetary policy works through financial conditions. Financial conditions slow the economy. That then in turn slows inflation. So I don't ignore rates. I don't think the long rates are quite that useful as a policy variable for the exact reason you just talked about, which is they can move, pretty significantly over relatively short time periods. So I think, at any particular meeting, you're looking at financial conditions and other conditions in total, risks to the economy, and you're trying to make a judgment in a holistic way. I think they do enter my thinking. And so have they loosened since the last meeting? Sure, they've loosened since the last meeting. Where will they be at the next meeting? I have no idea.
Okay.
But I don't think of them as a policy variable. There are some folks who tried to estimate how many rate increases this much is all worth. And I think it's just two different metrics you're trying to compare. Or another way to put it is a 50 basis point increase in long rates is a 50 basis point increase in long rates. It's not the same thing as an increase in short rates. It just doesn't, that part I have trouble with.
Yeah, that makes a lot of sense. So what is for you the best measure of, when you're trying to figure out if you're sufficiently restrictive, which is the core of your mission right now, what is the real rate comparison that you're making? Are you measuring Fed funds versus current CPI, or Fed funds versus kind of expected PCE over a 1-year period? And how restrictive do you see policy as currently being?
So I do look at forward-looking real rates. The way I've been looking at it is, 1-year Treasury versus a 1-year CPI swap. I'm not saying that's the perfect way to do it. There's, issues with the methodology, but that's a decent way for me, what do people see over the next year forward-looking real rates? Of course, the challenge, as you well know, is that there are many different models of how to think about where the neutral rate is, and including one from the Richmond Fed, and they vary, and the confidence intervals are pretty large. And so I don't find myself taking a bunch of, I took a lot of comfort when real rates went from negative in the metric I described to positive, because then at least I thought, we're doing something here. But I don't have a lot of confidence in, this particular level, 2.3, 2.7, 1.9 is any sort of a perfect level of real rate. So I try to take signal from the economy. And I'm trying to sort through, as I'm engaging with all these businesses, what is happening to demand in fact, because that's a signal of, how restrictive policy is, and what's happening to inflation in fact. And so, I have a hard time declaring sufficiently restrictive at any particular point in time, because of course, when you see 4.9% demand growth, which I've of course said, I'm not sure I believe, well, what if we have more of that? Well, then I'd probably have to believe it. And if I start believing it, then I'd say, I don't think 4.9% demand growth is a good fit with, as I said in my talk, it's certainly not the fix for elevated inflation.
Can you describe what data dependence means to you? Because one of the reasons I mentioned that the bar for rate hikes appearing to rise is that we have had a raft of fairly strong economic data, right? We had, as you mentioned, bumper GDP for Q3. Jobs may have slowed down a little bit, but the report was still robust. JOLTS looked strong. The last inflation numbers looked pretty strong. Why pause again if the data actually looks to be still fairly robust?
Well, we'll get a bunch of data before the next meeting, including CPI next week and another CPI before the meeting. So we'll learn a lot more on inflation. I buy the perspective that unless it is extreme, you're not actually trying to swat at 1 month data. You're trying to swat at multi-month data. So you're trying to learn what's actually happening as opposed to things which get revised and seasonally adjusted. I personally think, when I say, as I've said, that I just don't have that much confidence that 4.9 is the economy I see, I realize that is a step back from data dependent in the way that you would just take the data as given. I feel like I'm gathering alternative data. I think you have to look in the mirror and ask yourself not to have confirmation bias, right? Not to go data shopping, not to say that doesn't fit my narrative, so I'm going with that other data. On the other hand, if you don't really see in the economy what the data says, I think you're right to stop and say, I'd like to see a little more evidence of that. So that's the balance I think I feel I'm striking, which is, for the most part, the data that comes in should be taken at face value. It's the best we've got. If it doesn't fit what you think you're hearing, then you ought to ask yourself whether you're talking to the wrong people. If you convince yourself you're talking to the right people and you're actually hearing something different, you shouldn't hold on that different view too long. On the other hand, you shouldn't just jump around with every month's data.
That seems fair. What is your level of confidence in the notion that the recent disinflation we've seen will continue in a fairly smooth fashion? And what are the bumps in the road that you might see? For instance, there's one question in the chat that asks about the recent spike in shelter inflation, and whether it's a one-off or it's something to worry about. What do you think? How are you thinking the inflation path will develop in the coming months?
So I keep trying to test this as I talk to price setters in the economy, and sometimes I'll do a Chamber of Commerce thing, and I'll do a little, you're all small businesses here, raise your hand if your planned price increases for next year look less than pre-COVID levels, the same as pre-COVID levels, higher than pre-COVID levels. And, it's clearly better today than it was a year ago, clearly. But what I hear is maybe only 10% less than pre-COVID levels. Those are apparel goods manufacturers who's seeing some sort of price reversals. And a good half of the room is still raising price. So I don't see us as done yet in terms of the behaviors of price setters, if not yet squared with the behaviors that they had pre-COVID. I anticipate still more deflation or disinflationary movement on goods over time, because there are a lot of supply chain issues that have been repaired, and those things are going to balance. I think the pressure on services is continuing, is what I see. And on shelter, obviously in a big picture sense, it's not as frothy as it was. But most of the folks I talk to in the apartment business or in the housing business, prices are still going up. Rents are still going up. And so, I don't think there's some magical deflationary thing that's going to help us on the shelter side. So my forecast, my anticipation is it'll be bumpy and it'll take some time. On the inflation side, I'd be thrilled, of course, to be wrong about that.
Okay. So we have a couple of questions on the other end of your policy toolkit, which is about rate cuts. One comes from Craig Torres at Bloomberg. He asks, financial markets are pricing in about 100 bips of cuts. In other words, a 50% plus probability of a very slow, soft landing or recession. Is that in line with your probabilities for the year? And another way to ask it from another one of our guests is, if inflation continues to cool in early 2024, is there a case to cut rates in order to prevent policy from becoming more restrictive? In other words, just cutting the nominal rate in order to keep real rates constant.
Yeah, we've been on I don't know what it is, 18-month journey of answering this question about the market is pricing in, rate cuts at a different level than what, for example, the SEP would suggest. My simple answer to that is each of us in the SEP has a forecast, and that forecast, makes some assumptions about, what happens to inflation, and then the rates follow on that forecast. And it's certainly possible to have a more optimistic forecast about the economy than mine is. So I don't judge anybody for having a different forecast. We'll see what happens. I mean, I think the reaction function as implied with the SEP is probably as good an indicator as you're going to get, but let's see what happens.
Great. Well, I'd love to have you walk us through what you are hearing from your business contacts in the various, realms of data that we care about for policy. One of our viewers asks about a reference that you made to what you're seeing in the region doesn't wholly corroborate the bumper retail sales numbers that we've been seeing, and they ask, what are you seeing on that front and hearing from your business sources?
And we covered a little bit of this earlier, but I'm hearing that demand is solid. Very rare to find somebody who actually feels that demand has come off. Really, nobody is saying demand is frothy. Even folks who sell to higher income people would not describe it as frothy. So I sort of feel like, from a consumer spending standpoint, we're in a trend-like economy. Wealthier spending more, middle income trading down, lower income stretched and reprioritizing, but supported on the lower income side by wage growth and high employment percentage, and in the upper income side by equity prices and home prices. And so I think folks keep spending, and that's the economy I think I see. And I square it. If you took retail sales year over year, it would be 3.8%. It's not the right deflationary instrument, but headline CPI over the same period is 3.7%. That would imply 12-month retail sales, real retail sales, kind of flattish. If you did the same experiment on real consumer spending, you'd get about 2%. And so, call it 1 or 2%. That's what I'm seeing on the consumer spending side. And like I said, I think we had a weak second quarter, and these numbers are quarter over quarter. And so I'm anticipating we're not going to see another quarter over quarter boost in the fourth quarter. In fact, a much more flattish, because that's the economy I think I'm seeing. On the labor market, it's clearly come into much better balance. The place it's clearly most in balance is professionals. People like you and I don't want to leave the current job and be the last guy into the new job, and therefore the most vulnerable at the moment of a layoff. I mentioned that the layoffs have been disproportionately in the administrative support and overhead kinds of functions. And so what I hear is, you could talk to people at colleges or business schools. I mean, the hiring process has really gotten a lot slower. So the professionals, I hear that's a normal economy, maybe even a little soft, with an exception or two around cyber and advanced artificial intelligence type things. On the skilled trades, I still hear that's very, very hot. Construction, manufacturing, nurses, veterinary assistants. We were short before COVID in most of these functions. We got shorter during COVID, and demand remains healthy, and there doesn't seem to be a supply fix to that just yet. So you're still hearing wage pressure. You're still hearing vacancies. You're still hearing the kind of hotness that you heard even a year ago. The front line, somewhere in the middle. I'd say most of the folks I talk to are getting by. There may still be a short, but they figured out how to handle getting the job done with fewer people. The hotel example is the easiest one to get your mind around. Housekeeping every other day versus every day. The lounge isn't open. The checkout might be a little short-staffed, but they're getting it done. Automation. You talk to a lot of fast food people who are investing significantly in automation or job redesign. The person at the drive-through is also handling you inside. I guess I'm exposing myself for how much fast food I eat, but I think frontline folks are getting by. The exception there is in some of the smallest towns. They're really in the small towns. They're really still struggling on frontline workers, and again, it's just an access issue. Housing plays a role. Transportation plays a role, but in most of the bigger cities, I'd say the frontline noise is kind of behind us, and so the labor, it's really it's a skilled trade thing.
And then to drill down on the inflation portion of that, you suggested earlier that pass-through is still fairly smooth, that companies still expect to be able to raise their prices. And is that driven in part because by ongoing demands for higher wages for catch up from their workers?
I think it's totally driven by experience. And first of all, I'd say not everyone feels they can do this. If you're in apparel right now, you don't feel like you can raise prices. You're dealing with an inventory overhang from last year and all the rest of it. So there are sectors where it feels more like 2019, 2018. And there's sectors like hospitals that actually still have not been able to raise their prices. But in the broader swath of services, what I'd say is for 30 years, businesses got trained that pricing wasn't a lever. E-commerce made customers price sensitive. Globalization meant there was access to alternative supply. The power of sizable intermediaries like the big box retailers to negotiate price meant that people just didn't have the confidence to raise price. And for example, when the tariffs came in 2018, I talked to a lot of importers and asked, were you going to raise price to Home Depot and Best Buy? And they said, oh no, I can't do that. Like, I can raise price to smaller retailers, but not to the big guys. Well, COVID happened, supply chain issues happened, costs increased for everybody. Supply availability became the priority of the day rather than price. And so a whole bunch of people got the opportunity to raise price during COVID. And of course, what they found out is that they liked it. It's the quickest way to get money to the bottom line, assuming the consumers take it. And so that lever isn't as powerful as it was, but it's still out there in the toolkit in a way that it wasn't in the toolkit 4 years ago. And that's what underlies a lot of my thinking on inflation. So, one thing I like doing is just monitoring the earnings reports of some of the big consumer products companies, Conagra, Kraft, Pepsi, P&G, and they'll break out price versus volume. And if you look at a bunch of them, what you'll see is that in 2018, 2019, price was up 1 or 2%, volume was up 1 or 2%. That's the economy that those people lived in 2018, and they were just eking out every bit of mixed management to get price up another half a percentage point. If you go to the heights of COVID, price was up 15 to 20%, right? And unit price and volume, plus or minus, was sort of steady, right? And so where they are today is they've come off of that, but price looks like 7 to 12%, and volume looks like down 3 or down 4. And so the net of that is still profit enhancing. By the way, really hard to stop it, because if you stop raising price in a negative 4% volume business, then you've got a problem the other way. And so they're backing off of it. but they're not all the way back yet. And getting all the way back is going to require either competitors or customers putting enough pressure on you that you've got to get back. And I think what I see in those reports is what I hear on the ground is that we're off of the spiky supply chain oriented price increases of the past. But if you're in a sector where you think you can still move price, you're going to try. And you're going to try in a way that is different than the way they tried after the tariffs in 2018, for example.
Okay. Megan Casella from Barron's asks the following. You mentioned already seeing a slowdown in rate sensitive sectors while other areas remain strong. How would you adjust policy if parts of the economy like manufacture enter a downturn while inflation remains above target? A stagflation-ish scenario.
Well, that's a depressing scenario, but it's certainly it's in the potentials. I think I do believe we have policy that's restrictive today. And I think it's important, so long as inflation stays higher than target, for you to have restrictive policy. Obviously, as I said before, the stronger demand is with high inflation, the stronger it makes the case to do more. The weaker demand is, the weaker that case to do more. So, when would you start dropping rates is, I guess, the other way to ask the question. As I said before, you'd want to get convinced inflation's on a path to where you're targeting.
There are quite a few questions on the role of the fiscal policy might be playing in keeping the economy humming and kind of working against Fed policy tightening. How much is the fiscal largesse that we've seen post-COVID a tailwind for the economy and maybe a headwind for your policy goals?
Well, while I'd love to say I could control fiscal, I can't. So it's an environmental factor that you take as a given, not unlike oil prices or anything else. You just have to deal with it as it exists. At an overall level, there are significant deficits, and I certainly learned growing up that has an inflationary impulse. On the other hand, to the extent the supply side can get worked in ways that help lower the pressure on wages and prices, whether that be on the energy side or on the labor side, I think that'd be helpful. And so, we take it for what it is and make policy against it as it exists. And it'd be, it's hard not to notice on the construction side, for example, that a lot of the infrastructure spending is, creating pressure on construction employment, right? Which is part of the skilled trades thing I talked about. It's also true that labor supply has come back up over the last year and a half. And a significant part of that, as best I can tell, is people born outside of the country. So that's immigration policy. So there's a lot that goes on that plays on both sides of it.
Are those trends that you described in the labor market, did they give you confidence that a rebalancing is more likely, that you actually need to inflict less pain in the employment side in order to bring inflation down?
Well, I don't think the objective is to inflict pain. I think the objective is to get inflation down and, hopefully at a minimum amount of stress. It certainly has helped on the labor side to have increased participation by prime age. Prime age women are at record levels of participation. Percent of the workforce born outside of the country has come back up, and that certainly helped, and that would help. I don't know how much more you can count on. You've already got prime age participation above pre-COVID levels. The place that's still down is people 60 and up. My people, as I like to call them these days, and I don't know how much more participation you're getting from there. It doesn't seem like the numbers are moving. At least they haven't over the last couple of years.
Along the same lines, my colleague Jean asks about the latest productivity data, which is pretty decent, and whether it squares with what you're hearing from firms. And she mentions that one of the narratives has been that people switch careers and productivity has suffered as they were getting trained, but that has some kind of long run payoff that we might already be seeing. What are your thoughts?
So, COVID just played havoc with the productivity data, both the data itself, a lot of lower productivity people left the workforce and it made the numbers look great. And then they came back in the workforce and it made the numbers look terrible. But also this point that if you're a manufacturer and you couldn't find any employees, and so you lowered your standards and took in just anybody, they weren't going to be as productive. So I think you have to look at productivity on a 4-year basis, not a 1-quarter basis. And the 4-year numbers for productivity, I think these are the right numbers, would suggest 1.6% annual productivity growth, which is up marginally from the 2010s, which was about a 1.4% productivity. So you could argue we're up a little bit, and some of that would make sense given, when you're short workers, you try to use automation and other process changes to do more with less. But I don't think there's any sea change in productivity yet in the numbers as they come in. So it's reassuring, because if you did the 3-year numbers a year ago, right, and you just pre-COVID then you would have said, oops, productivity's down and we've got all kinds of problems. Now at least you can say productivity's back to pre-COVID levels, maybe a smidge better, and that helps if it stays. But as you know well, that data is very, very jumpy.
Part of the fiscal largesse story that we've been discussing is the issue of excess savings and how much of it consumers have left. I wonder if you have a working assumption as to how much firepower consumers have left in their pockets, and what it does to your growth outlook.
Most of the analysis that I've seen and the stuff that we've done in my shop would suggest, if you just looked at it on an excess savings level, in other words, saving rate was 6% pre-COVID, it's been 3.5% for the last period of time. How much it was, 14% during COVID, how much overage, underage, that would suggest there's still some money out there, but it's clearly, we're in the last quarters of it. I think, though, that number made a ton of sense to follow a year ago. And now I think you actually have to follow the wealth numbers more significantly. I mean, equity values up a ton, housing values up a ton. And those numbers in aggregate swamp the excess savings numbers. Now, most of the economists will tell you that people generally don't spend freely out of wealth. They have a lifetime savings model of wealth, and so they'll spend it down ratably over time. And so they would suggest the marginal propensity to consume is not that high out of the wealth numbers. But I think we have to ask ourselves whether that's still true. I mean, the extension of the very low savings rates over the last, I think it's 18 to 20 months, makes you ask yourself the question whether people who went through an epidemic where maybe friends and peers passed away or had health issues and wondered how much longer they had to live, whether people are going to spend at a different rate coming out. So I'm spending more time trying to think about that. Is there some sea change in how people think about spending out of their wealth that could end up with a higher consumption, a lower savings rate, a higher consumption process? And while, the sort of these regularities seem very stable, just a reminder that coming out of 2008, an economy had a much lower savings rate pre-2008 than it did after 2008. And, that near-death experience for many of us maybe led us to say, hey, wait a second, I've got to save. And so maybe this near-death experience for some of us is leading people to say, if I've got the resources, why wouldn't I spend it now? So that's what I'm trying to understand.
Are there any other semi-permanent or long-run changes that you see in terms of COVID's effect on the economy, whether it's, some kind of underlying labor market strength or a higher neutral rate of interest, and that, that leads us to believe that rates will be higher for a longer period?
Well, I mean, the book's obviously still being written, maybe even by some people on this call, but I'd say, obviously, hybrid work is something to pay a lot of attention to. Women's labor force participation at record levels is something it's hard to miss, and it's particularly up with women with college degrees and children under 5. And I don't think I could prove this to you, but it's pretty straightforward to jump from that and make the assumption that a more flexible work environment is either having a beneficial effect or is having people forecast a beneficial effect on your ability to participate in the workforce and deliver to whatever you're trying to do at home. So that's a pretty significant shift. On the downside, and that's a huge upside. On the downside, of course, you've got center cities and a lot of big cities that are struggling, and retailers in those places that are struggling, and stranded costs of significant proportion. So that's a whole nother on the flip side. So one of them is perhaps how people spend. The second is how people work. It's also having an impact on exurbs. Housing short most everywhere these days, but the one place in my district I'm seeing tons and tons of housing being built is Eastern North Carolina. And up and down 95, you've got these communities that are an hour or so from Raleigh, and probably weren't buildable communities for people to live and work. And I think you've got people living there and saying, yeah, I've got a long commute, but it's only 2 days or 3 days a week. I just think it sort of opens up a lot of development in the exurbs. Other stuff that may come out of it, I think, how would I put it? So there was a narrative 15 years ago about demographics that suggested that we're all doomed because labor's been long for so long and it's going to be short. And the 2010s would argue against that argument. Participation kept increasing. In a strong economy, more and more and more and more people came in the workforce. Well, now we're on the back end of it. And it seems so much clearer to me today that we're going to be living in a labor is short environment for the next 20 years. And that'll have implications, obviously, for how people invest in automation. That'll have implications potentially for wages. That'll have implications for, how people structure. I just think that's something we're going to have to pay attention to, and I think will be a big part of the story. Another version, I'll call it deglobalization. Someone else has called it friendshoring, but this notion of supply chains not just being a cost issue, but being a resiliency issue, and what that does in terms of companies and their global footprint, might be very beneficial to places like Mexico. But we have to see how there may be a reshoring thing. I'm not hearing a ton of it in terms of onshoring. But I think those footprints, I mentioned before, the elements, the tailwinds that were keeping inflation down over the last 30 years, including, demographics, big box retailers, globalization, fracking. And it's not hard to imagine, we'll be riding into headwinds on the inflation, front. I've given a talk on this. That could include deglobalization, energy transition, fiscal, as you talked about. So there's a demographic. So there's a bunch of these things that I could make an argument are going to be nothing's permanent, but critical features of the next 15 years. But we'll see. We'll see.
And I would add potentially, the increased need for military spending given all the conflicts around the world. Yeah. So that would be a kind of new inflationary factor against which you'd have to measure up the other things going on in the economy, right?
Yeah.
Okay. If we could talk about credit conditions more concretely, we talked about, sufficiently restrictive in terms of rates, but how are you viewing credit conditions and lending and actually hearing about them from your contacts? As of March, we had a regional banking crisis that everybody thought was, going to lead to a serious credit crunch, and that never materialized. This latest spike in yields kind of raised similar fears. We haven't seen it yet. What are you hearing and seeing on the lending front?
So it's very clear that banks, also maybe I'll take a step back. Thank goodness, the fears a lot of us, might have had in March seem not to have been realized beyond the four big banks that were hit in that time period. And the banks in my district that I talked to have invested heavily in liquidity, and deposit flows seem stable, and the businesses seem sound. They are concerned about tighter margins because as they paid more for deposits, they're not really charging more for loans, and so you see a reasonable amount of cost cutting going on there, and you do see banks cutting back. And as I said, it looks like it's specifically high risk sectors, newer customers, marginal credits. On the customer side, the place where you just hear lots of noise is developers, particularly office, multifamily, the deal volume is just off significantly. And so I think there's no question you're seeing credit tightening there. And as I talk to banks, I get the feeling that the combination of higher interest rates and their own efforts to protect their balance sheet and their business are leading to, credit tightening on the commercial and small business as well. Less on the personal. I think in the personal, it's a credit score thing. Certainly on lower income, lower credit score, lending, they've cut back. But, it's not like you can't get a mortgage today if if you can afford it, you've got a house. So I think that credit tightening, that's part of why I think there's still more to come. And I really was struck by that number, personal interest payments as a percent of disposable income. It's only at 2019 levels. I mean, so as people have to refinance, or people with variable rates and they go up, and that number is going to go up. So there is still tightening to come. That is definitely part of my outlook.
Do you think that part of the reason why the Fed is now kind of in pause mode and not even hiking anymore is that policymakers are, whatever you think the lags might be, that there's kind of agreement that there's still a significant amount of effect to come from your past hikes? Is that a view that you subscribe to?
Well, I won't speak for what others say. I think there's more lag to come from hikes. I'm not sure that that's everybody's view, but that's certainly my view. I also believe that there's inflation is going to take longer to settle than the more optimistic forecasts that you might see, and so that's my challenge when it comes to that. Is I think there's more to come, and I think there's more inflation to come, and so I'm just trying to balance those two.
Okay. We have quite a few questions on, I guess, your tolerance for above trend inflation as well, asked in different ways. One questioner asked whether your 2% inflation target is outdated. I think I might guess your answer to that one, but let me ask it to you this way. What does taking 4 years to return inflation to target, what does that do to inflation expectations and to kind of trust in the Fed to achieve its mission regularly?
Yeah, so I get this question about whether 2% target's outdated a lot, and I struggle with the question because we were at 2% for basically 30 years, 3 years ago. So it's not like it's some imaginary animal that no one's ever seen in the forest. It's actually existed, and not only it wasn't just us; it was everyone in the world. And so I don't think there's any reason to move from the target or think it's outdated. I do worry about expectations. Now, I hope that the aggressive movement that the Fed initiated last year was helpful in terms of stabilizing expectations. I hope that the run of positive news, both in headline and core inflation over the last, since it hit its peak at 7.1%, and certainly over the last 6 months, is helpful to keeping expectations. And whether it's survey-based or market-based measures seem to suggest that inflation's still in line. But as I say about many things, that's not a right. That's something you have to earn every day. And so I do think, were we to see inflation move the other way, part of the case for doing more, doing longer is you want to make sure you're sending the right message to people who might be nervous about the commitment of the Fed to get to where you want to go. And so, but where we sit today, I think we're headed in the right direction. It's just a question of how fast we can get there.
If I could ask you about QT a little bit, it struck me recently that if you believe that QT is doing some tightening in the background, that even as you pause interest rates, you are still kind of passively or potentially actively tightening policy. How do you think about that? About one of your tools is still tightening while the other is on hold?
Well, so let me just start with QT in general. I believe you have to be even-handed and fair-minded in these. And so if you believe that there's any value to QE in terms of stimulating the economy, then you have to believe there's some value to QT in tightening the economy. I'm definitely not somebody who subscribes to some of the papers you'll see that attribute enormous impacts to QE or to QT. But if you're out there in the market buying bonds, presumably that, lowers the yield on bonds. And if you're, out there maturing bonds and therefore increasing supply as they get refinanced, that must do something to increase the yield on them. So I think there is a modest yield impact both in the QE side and the QT side. I also think there's a psychological impact. When Bernanke stood up in whenever that was, 2011, and said, or maybe it's 2010, we still have more arrows in the quiver, and here's QE. I, as a business person at the time, I understood that to be the Fed wasn't done and it's doing more. And I didn't need a model to analyze that. That just felt like more, and it was deeply appreciated. And so I think it's got a signaling effect that has some value. And I think, QT probably has a signaling effect that is a tightening effect. It's often referred to as liquidity when I talk to market participants, but whatever it is, that's something that's going on. So I think there is tightening that's going on. But like I said, I think it's modest. I think the real lever is the rate. And I do subscribe to, you can try to get back to normal here, even as we are doing, even if you don't increase rates at a meeting, if you keep doing that, that's a little more tightening in the background that is part of your overall package.
So one of our participants asks whether there's a risk that QT amplifies the increase in the term premium, and how long you expect the Fed to continue with QT.
I'd like the balance sheet to get back to, something that looks a lot more normal. I think we're still at 3-point-something trillion in reserves. Someone will have better numbers than I, but I think in September of 2019, when we sort of felt like we hit a number that was not quite, that was higher than normal. I'm sorry, we hit a point where markets reacted. I think reserves at that point were about 1.2 trillion or something like that. And so, I'm not too worried at 2 trillion in reserves that were that close to the line. Not that I aspire to get that close to the line again, but I think there's still room to go there. The overnight RRP is still basically at about 1 trillion. So, which wasn't true. So there's still a very significant amount of liquidity that's in there. And I'll take signals from, what we see in terms of the pricing of the Fed funds rate as to when things start getting tighter.
And what is your view on what seems to be a budding debate within the central bank as to whether you could continue QT even after you've started cutting interest rates, thereby kind of sending, even
is that a budding? I hadn't heard that debate, but I guess.
Well, I've heard different views
in the
committee. So,
I think we've said, multiple times that you do want to think about your tools in total. So, you don't want to be doing, this with the left hand and this with the right hand. I think I've heard the chairman say, and I certainly subscribe to it, that continuing QT after you, normalizing the balance sheet after you have started to pause rates is not in conflict. I'd have to think more about, the situation you're in, whether lowering rates was an effort to bring rates back to normal. In other words, we've now engineered this perfect soft landing and it's now time to bring real rates back to the neutral level. Or if what we're trying to do is to respond to a set of things that are driving the economy into recession, you're trying to be accommodative. My initial instinct, and I want to think about it more, is there's a difference between, the tightening of QT normalizing working against accommodative posture versus QT normalizing working against a normalizing posture. But I'd want to think about that more.
That's great. No, that's really useful. And if we stick to the normalizing scenario, do you think it might be difficult for the Fed to communicate that idea? If we are in a nice soft landing and you start cutting rates, isn't the market going to start to think that something it doesn't, as market participants often perhaps erroneously think, and therefore think that it's kind of an aggressive easing rather than just a normalization?
I haven't gotten any signals that the market be stressed out about us reducing rates. I think I'm actually hearing the opposite, but whatever. I think
I guess I don't mean stressed. I mean that they might
yeah,
sort of take it to heart and price in way more looseness than you're intending, I guess.
I think those are always risks. But I think, you've outlined a scenario which would be a welcome scenario where inflation comes back to target in a very nice, convincing way. And that we as the central bank say there's not a need to be as restrictive anymore. And I think we would have to communicate that, and also, what we would be tracking as we brought rates back into normal territory to figure out how far and how fast to go. But presumably you have a point of view, and you can tell from the way I'm answering that this seems like a really high-class issue to have somewhere down the road, but it doesn't feel like the particularly pressing issue at this second. But I think you want to communicate how you think about where neutral is and what you'd be monitoring to get there. That would give some guidance, I think, to people who, I think the real issue would be people having different views of neutral. It probably wouldn't be people having different views of whether there's a recession around the corner. It'd be someone thinking you're going back to X when in fact you might be going back to Y.
Sure. Does the role of QT as a liquidity withdrawal tool, does that pose financial stability risks in your view? And just if we could just broaden the discussion to, if not that, what are the financial stability risks that you are concerned about?
Well, certainly as we've exercised QT in the past, we've learned it's not just a perfect, seamless, can't get anything wrong kind of tool. And so I think as you get closer to the level where you might wonder about whether you're pushing it too far, you slow it down. And I think we've been pretty clear about how to think about that. There are always financial stability risks. It's a pretty dark place when you start to think about them. One that we don't generally talk of as financial stability, but I think in an era of increased global conflict, you have to think about is cyber and the potential to shut down parts of the system. And so it's not something we control other than in our oversight of banks and trying to make sure folks have got appropriate cyber defenses, and ourselves, of course. But it's that's a scenario where you really, could imagine, issues. You've then got issues in the banking system. A lot of people talk about commercial real estate, which is a reasonable thing to do. I hope and expect, that's not a new risk for banks. They've had issues before. I hope and expect, they've got enough capital and figured their way to handle that. But, we'll have to see. Hidden leverage is something I worry about. We know where the leverage is in the banks. We don't necessarily know where all the leverage is outside of the banks. There was a volatility fund in February of 2018 that I think lost 85% of its value the day after the tariffs were announced. And, I'm sure the people who signed up for that fund didn't sign up for that much volatility. And how you got there was undoubtedly leverage. And so, where's leverage that could end up biting you? That's always something to pay attention to.
One questioner asks whether, without asking you, of course, to comment on other central banks' policies, there's increasing concern about the potential abandonment by the Bank of Japan of its yield curve control policy. And the questioner asks whether you're worried about the impact this might have on demand for U.S. Treasuries, given the historic role of the Japanese as strong buyers of bonds.
Well, there are a lot of stories about what's happened to the long end of the yield curve over the last several months. One of the stories that I've heard from multiple people that intuitively makes sense to me is there's been a lot more supply of treasuries and there's been some reduction in demand. And when supply and demand changes, obviously price changes. And we talked a little about the supply earlier. On the demand side, I would imagine that the higher the yields get in Japan, the less incentive Japanese buyers would have to, buy yields outside of the country. So that seems like a sensible, not sensible. It seems like a predictable outcome if that's, what happens and they decide to let long rates go up. So, I mean, that I think those are among the challenges we've got.
So what, somebody else on the financial stability thing, somebody had a follow-up question about private credit. Is that one of the places where the leverage could be hidden that you mentioned, where we might not know it exists?
Yeah, I mean, there's a lot of coulds in that question. So I don't know anything in particular to say that is where it would, but that's certainly a big growing sector. And when the private credit business was in the banking system, you would find banks that were overexposed, to credit risk there. So it's certainly possible. But again, those are areas that are less transparent to me in my job. And so I could speculate. I don't know.
Can I ask you a super specific question, which is why the word financial was added to the statement in September? Because there was already a nod to credit conditions. I just, some of us in the room were kind of puzzled between the difference between financial and credit conditions, which is just a way to nod to the recent spike in yields.
The way I interpret it, I mean, there are lots of ways people could interpret words, and maybe even my colleagues would have different views on it. But I interpret it as the conversation we had earlier. I mean, financial conditions had tightened, thought broadly, as rates had gone up. Credit conditions had tightened as well. And I think it was just an acknowledgement. In my mind, I just saw it as an acknowledgement of the very real fact that, no matter what indice you look at or what structure you had to think about financial conditions, they had tightened.
Yeah. The Fed is privileged perhaps in being able to kind of really focus on the domestic outlook for policy. But I wonder how much you factor in economic weakness that we're seeing in China. I mean, if you gave somebody this constellation of kind of global factors, you'd probably think that the US would be feeling some of the pain that is emanating from other countries. And yet here we are with 5% GDP. Whether it's slow growth in Europe and China or the wars in Ukraine and the Middle East, how are you thinking about all those and how they might affect policy in various ways?
Yeah, I sort of think about it like the fiscal conversation we had earlier, which is, well, for sure, there's nothing we can do to control it. You sort of have to take it in both what's happened, demand from China, for example, or what potentially could happen, an oil price spike that happens because of one or another of these geopolitical conflicts. You have to take them into account as you're making policy. And of course, as time goes on, whether it be, we had a big spike in food prices coming out of the Ukraine war, and then that, for the most part, has come back off. And, we obviously understand the risk of an oil price spike, coming out of the conflict in the Middle East, or maybe it'll end up in a place where you decide those risks come down. I think those are all, they go into the conditions that you're taking account of as you try to make policy.
Now, turning to the balance of risks and how you view them, there's been a shift in the language, even when you hear from the minutes in terms of policymakers seeing the risks of over tightening and under tightening as increasingly more balanced. But given that given the nature and magnitude of the inflation scare that we had, why not just stick to a kind of Volckerian inflation fighting mode and maybe overshoot a little bit, but be completely sure that you've vanquished inflation, as opposed to really trying to play the middle and land things softly in a way that might actually allow inflation to tick back up?
So I don't think my personal philosophy is not play the middle and take things softly. So I'll have a different characterization. Here's another way to think about it, which is, inflation spiked. Now it didn't spike to 15%, it spiked to 7%. If you wanted to take care of inflation unequivocally with zero doubt, maybe we should have just taken interest rates up to 21%, as happened, or maybe it was 18% in the 81, 82 time period. I bet that would have done it, right? So you're always, and if you don't think that made that much sense, then you have the same question at any number. And so we do have a dual mandate, which doesn't mean that you should just ignore inflation. You want to do, employment. You should do the maximum amount of impact on inflation that is consistent with maximum employment. And so We moved very aggressively last year because it was clear, at least to me, that we were, accommodating at a time where we needed to be restraining. And so you had to get to restraining as fast as you thought you could. Once you get into restraining, you probably move at a different pace, makes sense to me, because you don't have any certainty about how much restraining is enough. I'll take signal on the restraining, how much is enough from what we see on inflation in particular. And I don't know whether we're at the right level or not. And I think inflation will help tell me that. And so you could actually do more. I'm encouraged by how inflation's come down, that we're not so far out of the zone that, we're letting inflation accelerate and sort of piddling around. But, we'll learn more as we go here.
Are there any issues that you'd like to raise as an FOMC member as you go into next year's framework review? We talked a little bit about the inflation target. There is another framework review. Do you think that flexible average inflation targeting has been successful? Some people have blamed the framework shift for, forcing the Fed to remain too loose for too long. Are there any changes that you'll be advocating in particular?
I think we have a lot to learn from this particular episode that has not yet been concluded. So to me, when you're on the other side of this, is the right time to be thinking about the framework. When you learn whether things like flexible average inflation targeting, or even, we're not going to anticipate, I've forgotten the phrasing of it, but, we're going to anticipate realized inflation as opposed to, projected inflation. I think those are good. As I sit here right now, those are really good questions to kick around. But, if we have a scenario where, the soft landing that I thought was unlikely to be as soft as that, if that just comes through very nicely, you might go, well, tell me again what the problem was. We got from here to there and it all works out, as opposed to, no, wait, you really can't do that. So I think there's a lot to debate, but I guess I would advocate for starting the debate when we sort of feel like we're on the backside of this scenario, as opposed to when we're in the middle of it. First point. Second point is, I guess I'm not one of those people who thinks that the framework was, all of a sudden you passed a framework and inflation arrived. I think we have to look hard at our forward guidance and, what we did in the forward guidance, both in the initial September 2020 forward guidance and in the quantitative easing December 2020 forward guidance, and ask ourselves the question of whether we think those two, stood up well with 2020 hindsight. And I think we will probably decide no.
Excellent. Well, we're getting to the end of our time. I wanted to close out by asking you laid out in your remarks kind of three possible growth scenarios. And I wonder if I'm correct in interpreting that you see the most likely as a mild recession, or if you have a most likely scenario out of those three that you outlined: reacceleration, soft landing, recession.
Modest slowdown, driven by lags still to come. We will need that modest slowdown because I think inflation is going to be stubborner than the last 3 months prints might suggest.
Great. Well, unless there's anything else you want to bring up, I just wanted to thank you for your time. This has been wonderful. Thanks again. That's President Tom Barkin from the Richmond Fed. Thanks for your time.
Thanks, Pedro.